All attendees are in listen-only mode.
Well, there we are. We're on the October edition of the Global Share Portfolio. Timing not great, because a little bit later today we're going to be getting the financial results for the third quarter from two of our big stock holdings. That's both Apple and Amazon. And then later in the week we'll be getting the quarterly results from Alphabet, or the old Google. So there's quite a lot that's going to be happening after this seminar, but maybe in a way it's a good thing, because we're going to do some big changes to the portfolio. Those of you who've been following us over the last few months know that I've been toying with Facebook. You also would know, as I warned last month, that we are having second thoughts about the Novo Nordisk shareholding. And I've been doing a lot of work on Elon Musk and the Tesla deal with the merger with Solar City, and there's some big opportunity there as well. So those are the big changes that we'll be getting into in some detail in this broadcast, and I guess probably just as well that we only get the portfolio returns, or those quarterlies, coming out later. Otherwise, we'd keep you here for a couple of hours. Anyway, I'm in London, as always, and in Johannesburg.
Yeah, thanks, Alec. It's Stuart this side. Just for the listeners, please send your questions through on that right-hand control panel. We'll answer them as soon as they come through as sort of in between the discussion. So, yeah, just pop them in there and we'll deal with it on our side.
Yeah, and Stuart, there's quite a lot of interesting stuff that we will be covering, or ground we will be covering this time round. So I think you feel free, please, to stop me, even if you think that I'm in my stride, in full stride. Let's just get onto the questions, because that's often where more interesting information comes along from. Okay, let's kick off with the look, or how the portfolio as a whole is looking. You will see there that there are four big changes. The first one, when we go down from the top, is to see Berkshire from 202 shares that we owned last month. We have decided today to sell half of that holding. So we're selling 102 shares, leaving it as a nice round 100 shares. The reason for that was, when we began the portfolio, the idea was to have about a third of the portfolio in the index tracker, another third in our two bankers, and that was Alphabet and Berkshire, and the final third would be through share selections. Well, what has happened is that we've taken out of the portfolio from the Vanguard to increase some more of our share selections, if you like. We've had Amazon, which has performed unbelievably well, and it's now become worth 18% of the portfolio after starting off with just 8%. We also added Apple as another banker. So the portfolio's got a very different feel about it to when we started 2 years ago. We still have roughly a fifth of the portfolio in the index tracker, and that will be lightened when we do our next purchases, when we find our next stocks that we'd like to include in the portfolio. I'm going to spend a bit of time on this slide, because it is quite important if you are replicating the portfolio. And remember, you can do that. Literally, you can actually do it today. Open your account, or if you don't have an account with WebTrader, with Standard Bank, it's very easy to do. You can invest R1 million without asking for exchange control approval. So that's another thing that you can trigger immediately. And do remember that with the Rand having shown some strength recently, it is a volatile situation that the country is in, and that can blow out very easily, just as well as I suppose it could also increase. And we do take account of that by advising, whenever you do purchases, to try and take the exchange rate out of the equation. Don't buy it all immediately. Try and stagger your purchases over 3 months. But let's get back to the structure of the portfolio. Alphabet has been a terrific performer. As you can see, we're talking about US dollar terms up 52% since we bought the shares in December 2014. That has brought it to also roughly about a fifth of the portfolio, and the incredible performance by Amazon makes it worth about a fifth of the portfolio as well. So those are our three bankers now. We have the S&P 500, in other words, the index tracker, plus Alphabet and Amazon, and we're very happy, for reasons that we can articulate later, to have those two stocks as our bankers. Berkshire Hathaway, as you'll see, has now come down to 6% of the portfolio. The original target was at 15. The reason for that is that it has become a pedestrian performer. It's likely also to, at best, track the index. It has underperformed the index in the past 2 years since we've held it, and it has no longer the whole intention of Berkshire, together with the index, was a very defensive position that we started off with. Remember, rule number one, as Warren Buffett says, don't lose money. So we were quite keen to follow our view, our overall umbrella view, which was watch out for the rand. We felt the rand was going to get weaker because of poor economic policies being followed by the Zuma administration. You don't have to be a genius to work out that that has been an excellent call. And if that was your primary call, what you wanted to do was to try and keep the portfolio itself as stable and as defensive as possible, because actually the rand weakness was going to do all the work for you. That is why we had such a big shareholding in the index tracker and in Berkshire, which between them made around about 50%, almost 50% of the portfolio when we launched it. Reject somewhat because we are getting more confidence in our bets in the stocks that we are selecting in the US market. We've also done a whole lot more work on these things in the last 2 years, as you can imagine, and feel that being based in London does give you a better understanding of what's going on in the global economy rather than when I was in Johannesburg. So all of those things have combined to perhaps give a little bit more confidence to the decision we are taking today. So we've sold off half of the Berkshire holding, and we'll retain that for the in the medium term. Apple is doing a lot better. It was an underperformer, quite a bad underperformer for a period of time, but we are quite happy that that is a stock that is going to get back to its rightful position. Novo Nordisk, I've been very disappointed with. We'll get into that in some detail, and we've sold it out of the portfolio. The fundamentals there have changed quite dramatically. We've taken a knock of about 12% on the holding, which compared with the way the rest of the portfolio is performing is not an exciting return. On the other hand, fortunately, it was only a 8% at its maximum holding in the portfolio. So the overall impact of a losing bet has not been that bad. IBM, we retain there. Barclays Bank, we had the misfortune of buying that just before Brexit. At the time, everybody felt Brexit was going to be, enhancing the pound value, as we all know now. That decision in late June has done exactly the opposite. So although Barclays is up in pound terms, which is heartening, because the banks took an awful hammering in the UK after Brexit, in rand terms, it's actually down because the rand is appreciated against the pound. Or perhaps you should put it the other way, the pound has fallen out of bed against pretty much all currencies post-Brexit. But the big exciting news as well there is that we have added Facebook and Tesla. They're our next two. We've been playing around with the Facebook investment for a while. You'll recall the fundamentals of the business I have discussed kind of on and off. I love this company. Being in the online media field, it is a field that I believe I understand better than most other fields. And Facebook is really one of the exponential businesses, almost like Amazon, for the long term. What I've been doing there is making a mistake of actually holding back and trying to wait for a pullback in the price before we could make our entry. That, of course, is alien to the overall portfolio approach, which is try and take out the price issues and the currency issues by staggering your purchases over 3 months. So we've done just that now. We've bought 1/3 of the Facebooks that we're going to be buying and 1/3 of the Teslas that we're going to be buying, with the proceeds from the sale of Novo Nordisk and half of Berkshire Hathaway. So if you're an aggressive investor and you don't mind taking a punt on the currency and the current share prices, well, I suppose you could go out there and put 3 times the investment into Facebook that we've done. We think, though, that as a long-term strategy, and certainly this portfolio is a long-term investment portfolio, that you should be trying to take the currency and the prices out of it and just buying the company, not the share. So we've made an investment into both of those now. Facebook on the really surrendering to the fact that this is not a share price that seems to be going backwards at any rate of knots. Also that we do feel that by buying it over three different blocks, we'll be making an investment at or taking out both the rand and the Facebook share price of the equation. It is a long-term holding. Tesla, on the other hand, is looking particularly appealing at the current share price, and there's particular reasons for that as well. So there's the overall portfolio. As you can see, it has delivered an excellent return over the period of over 50%. In fact, we're sitting at 29% annualized. We'll get into that in a moment as well. In rand terms, there it is, the 54% rand return over the 2 years, or 22 months if you want to be exact. And you can see the individual constituents of the portfolio and how well they have done in terms. And this really was the whole intention, to make a rand investment for rand shareholders rather than putting your money into the Johannesburg Stock Exchange. It was look at this alternative, and we would guide you on a monthly basis, as we're doing right now, updating the portfolio and explaining how it's going. Remember, the portfolio also is a long-term holding, and long-term in our terms is forever, unless circumstances change or unless you want to restructure the portfolio because you find something better. In the rand column there, you'll see really good returns, or unbelievable returns really, from Amazon and Alphabet. Those two have been our big winners by quite some distance. Then a reasonable return from the S&P 500 index. That was a bet against the rand in essence, as you can see from the previous graph. In dollar terms, the S&P 500 index is only up by 5%, but when you look back here, you'll see in rand it's up by 28% since we bought into the portfolio. Berkshire has been a little disappointing, underperformed the market. Apple was one that we still believe, we might have timed our purchases a little unfortunately, but we still believe in this one. And indeed, the Apple share price at one point in the past year was sitting at $90 a share, when we were looking rather sad, or the portfolio was taking quite a battering from its impact. But it's now at $117 a share, and after the quarterlies are released, perhaps that'll go higher still. IBM, long-term bet. Barclays, you know the story there. We really like the turnaround story, but Brexit has hurt it. And there's the two newbies, Facebook and Tesla, which will end up with at 9% and 6% respectively of the portfolio. So they're both, at this point anyway, part of our share selection or share picking, but we're quite excited about the potential of both of those. Annualized return of this portfolio since we started it was 29%, and you can see the impact that the rand has had against the pound. The rand has strengthened to just under 17 against 21 when we bought the Barclays shares, and against the US dollar, the rand has been going the direction we anticipated. Here are the individual stock performances as well, which provides the latest figures and the annualized the rand profit since inception and the annualized profit. Again, only Barclays is one that we are concerned about in rand terms. Everything else is up, and there's a graphical representation of it, and you can see there that the Amazon and Alphabet, we had two bets. Interestingly enough, if you talk to private equity people, they will tell you that of a portfolio of 10, if you can have one winner, you are doing exceptionally well, because it will offset a number of losers. Well, in our case, we've had one unbelievable winner in Amazon and one very big winner in Alphabet. So those are the two that have ensured that this portfolio has outperformed quite considerably. The dividend receipts, not something that we pay too much attention to, but this is something that I'm sure you're quite interested to know about. Why Facebook? Well, there's Mark Zuckerberg. It is a exponential stock. It's an exponential company. Anybody who has seen the growth of Facebook over the past 10 years, or followed it in that way as clearly as I have, will know that you are here in a whole new world of communication, of engagement. The media industry is, and on the one hand, it loves Facebook because Facebook sends it quite a lot of traffic. On the other hand, it hates Facebook because Facebook is becoming a substantial distribution channel in its own right. We think that the Facebook effect is going to continue, and we think that it's just going to go stronger and stronger. And I wanted to put this, or have put this graph here so you can see the performance of Facebook in the past year. We should, of course, have been buying it in February this year when it was under $100 a share. That wasn't a decision that we took there. The results that came out in February, as you can see, that big jump there from the mid-90s to over $110 a share, showed that Facebook was on track, even if the rest of the market was at that stage, or most people were a little bit disappointed. The technical analysts are going to love the fact that on the 50-day moving average, Facebook has remained above that now for the last 6 months, and it continues to bounce above that level. It's had quite a sharp uptick in the last few days. This is in anticipation, I have no doubt, of good quarterlies again from the company. But as you can see, had you bought Facebook at any time in the last year, unless you were really mistiming your purchase, you would be pretty satisfied. We can expect that Facebook will, after that sharp increase in the last few days, it will probably come back to earth again, or certainly lose a few dollars in the share price. But who knows, when the quarterlies come out, maybe it goes the other way. Either way, we've started making our investment. We have taken 1/3 of the cash that we're going to allocate to Facebook. Indeed, we are allocating $22,000 of the portfolio to this stock. We raised $14,283 from the Novo Nordisk sale, and by selling half of the Berkshires, $14,670, together with $4,000 that we had in cash, gave us a cash pile of $33,000, and that's being allocated 2/3 Facebook, 1/3 Tesla. So $22,000 to Facebook, $11,000 to Tesla, and it's being spread over 3 months. So 7,333 this month for Facebook and 3,666 for Tesla. You can see, I hope that makes it pretty clear how we are handling these two. Moving on to Tesla, because
sorry,
why
just
not?
On
Sorry.
No, good. Del Felton asks, it's on a P of 63. I know you probably mentioned this. Is it not too expensive?
The problem with PE ratios with exponential companies is it is impossible to assess them on that basis. And maybe just very briefly, an exponential company is a company that grows its revenues and its business at a rate that is in excess, or far in excess, of the economy. It is something that it is a company that is multiplying or enjoying the multiplier effect. There could be many reasons for this, but as the world is changing, as we're going from the old economy, if you like, into this new information age, as we go from the third to the fourth industrial revolution, and I hope I'm not throwing around too much jargon, but just to understand this in a very basic manner. The industrial revolution began through steam. And then the second industrial revolution, you might remember steam, that was in the 1830s. The second industrial revolution came through the discovery of electricity, which was about 80 years after that. The third industrial revolution was through the discovery of computerization. And the fourth industrial revolution is the one we're going through now, which is the discovery of big data and being networked, technology taking an ever bigger place in our life. And it's actually interesting to have a look at this picture that we've got on the screen there, because this is a product of the fourth industrial revolution. That car, that Tesla, is not a motor vehicle. It is a computer that happens to have a chassis around it and a motor in it, and a motor vehicle, a mode of transport around it. Elon Musk, when he built this, never looked at what other people were doing. He decided that he wanted to take a computer and make that into a car. So a consequence of this is that you can or when they have an upgrade to some part of this vehicle, they will download it overnight through as you would do with a computer program. That's the way a Tesla works. So it is revolutionary in its break with the past and move into the future. Naspers is a very good example of the exponential effect in a South African context. If you'd been buying Naspers on a PE for any time in the last 10 years, you'd be kicking yourself today. Naspers is not a PE stock. It is a company that got really lucky 20 years ago or 15 years ago when it bought into Tencent, which was a small Hong Kong business. I think lucky is only part of it. It was part of a strategy that Anthony Roux and, of course, Koos Bekker, the great Koos Bekker, followed in that period. They believed the internet was going to explode. They believed the best place at that point, this is around the year 2000, to take your bets were in the emerging markets. So they had what is called a mud on the wall, or throwing mud at the wall strategy. And they bought many companies in the emerging markets that were in the internet space. They didn't have a 100% success rate by any means. In fact, just before the purchase of Tencent, they bought into the biggest internet service provider in China and took us 80 million rand write-off when that went bankrupt. But Tencent was the one that brought home the bacon. It's now worth more than 1 trillion rand to the Naspers portfolio. They invested $34 million worth 800, or it's the numbers are just out of the ballpark anyway. I think it's worth $80 billion now. It's been described by people in Silicon Valley as the greatest private equity investment ever. And if you'd said, well, let's buy Naspers on a PE, or let's buy Tencent on its latest profits, you would have been losing money in the last 20 years. So when you get to this point where there is a transformation in the industry, in the structure of the economy, the fourth industrial age is here. It's not like when the internet boom came in the year 2000, where there were over-optimistic assessments of what might happen to the companies that were being listed there. Well, I suppose if you'd bought Amazon, you would be quite happy with your investment today. But this is a shift throughout, and if you can pick those companies that are going to benefit increasingly through the various benefits that come for those who are first to market and who've got big market shares, those are the companies that you should be invested in, and those are the companies that you shouldn't look at the PE ratios. I hope that helps.
Just on that, Kev Johnson is asking, who do you think the next Alphabets or Facebooks are that they should look out for?
Well, definitely Amazon is the one that the whole world has stopped and looked at. I've no doubt that we actually, quite interesting on that, some investors believe that you should be offloading your win so that you can have more bets. I believe completely differently to that. And the Amazon investment, even today, I would be happy to buy those shares given the structure of the business and the way it's going, and definitely not be taking any profits. In fact, that's the genius to a degree of Koos Bekker. He bought into Tencent. It's returned unbelievable benefits to Naspers, and yet, despite huge pressure from investment analysts who have said, well, it's overpriced, or at this point or that point, Koos Bekker has stuck with it. And I think that's really all you need to do, is to find your winners and then make your bets, because you can see that those companies are doing things differently. I love, for instance, Discovery. I think it's an incredible business. We can't buy it because it's listed in South Africa. It'd be a bit silly to take rands and put that into a South African company. But Discovery has also got something very different. It's at the early stages of the shared value concept in business. And many of the successful businesses in the future, I believe, are going to be those who follow a shared value approach. How that works is that you make profit by making sure that those who you serve get a tangible benefit as well from using your services. Now, with Discovery, they are encouraging you to become healthier so that you can cut the price of your insurance on medical costs and life insurance. So if you follow Discovery's suggestions through its Vitality program, where it promotes get fitter, get healthier, do little things that will make you less of a risk. It benefits because you have a lower, it has to pay out less in claims, and you benefit because it passes on the discount to you. Now, there are many companies that are like that. The idea is to try and find the shared value pioneer in a particular industry, and those are the winners of the future. So when you ask who's the next Google stroke Alphabet, or the next Facebook, or the next Amazon, just look at companies like those who are giving you a service and making profit because you're getting something that benefits you. Think of Google. How much you would have to pay for library fees, for instance, to be ridiculous if you didn't have the Google service, or Facebook, what it would cost you to send letters to people rather than what you can do now by just talking to them on your page, or indeed on Amazon, what you would pay in additional costs to a retailer rather than getting it delivered to your home. And unfortunately, in South Africa, it's hard to get your head around this. But when you are in a country like the UK, literally, you shop on Amazon. If you need a new heater, as we did this week, we went on to Amazon and had a wide selection. In fact, we did it yesterday. It'll be delivered today. That's what the benefit of it is, and that's why if you want to find out more about Amazon, obviously there's conference calls, etc. But Warren Buffett has dedicated quite a lot of his annual general meeting, the Berkshire AGM this year, to the Amazon effect. So to find something else that's got that kind of effect, we think in both Facebook and Tesla we're onto something here. We believe that Tesla is, again, a shared value option. The reason for Tesla, just to get back to the purchase here, is not just because Elon Musk is a boy from Pretoria, but primarily if you have a look at that share price graph in front of you, Tesla is now, after being a bit of a rocket in the share price stakes for some time, it's been pedestrian over the last few months, which does give us a useful buying opportunity. And the reason for that is that Tesla is in the process of doing a merger with Solar City. Now, not everybody on Wall Street likes this idea. This, by the way, is a Tesla share price of the last 2 years. So you can see, had you bought it in February 2016, you could have got it at below $170. We're not paying much more since that. And in fact, we're going back almost 2 years in the purchase price that we're paying here. It's what was around October 2014. We're pretty much getting it at a similar share price today. But Tesla is doing this merger with Solar City, and what bothers Wall Street is the management of Solar City are the Reeve brothers, Lyndon and Peter, who are Elon Musk's cousins. Now, unless you know the Elon Musk story, you might be a little bit concerned that this is perhaps a bit of nepotism. Musk himself, by the way, is the chairman of Solar City. But the way they look at it, and the Musk boys and the Reeve boys grew up together in Pretoria. They had their first businesses as kids. They, in fact, made the Pretoria news as teenagers when they opened an arcade, or were in the process of opening a video arcade, and couldn't get a license because none of them were over 18, and their parents thought it wasn't such a great idea, so they weren't prepared to sign for them. But these boys have been, Lyndon and Peter and Elon and Kimball, have been friends. They holiday together. They're close to each other. They know each other. They've been business partners from all that time. In fact, Lyndon and Peter made quite a lot of money out of the first business that Elon Musk started because they invested there too. So to see Tesla Motors, which is Musk's company, or one of his companies, merging with Solar City, if you know that as background and you understand that they're a family and a very close family, is really no big deal. Why does Musk want to do it? Well, when you listen to the quarterly conference calls, he says that it's because the next big opportunity for both companies is in batteries, is in solving the problem of storage. Now, Solar City is the biggest installer of solar panels in the United States. It's an incredibly successful company in its own right. Tesla Motors, you will know, is the pioneer in electric motor vehicles around the world. In fact, between both of them, if they can combine their efforts into storage, in putting it differently, into batteries and getting that technology to benefit from Moore's law, getting back to the whole exponentiality thing. A guy called Moore in the 1960s, he worked for a company called Intel, discovered through his research that when you get a technology that is growing rapidly, its capacity or its power will double every 18 months for the same price. So we're seeing Moore's law at work at the moment in storage systems, in battery storage systems, which is one of the reasons why those of us who understand what's going on in Silicon Valley are so angry with the South African government's decision, or apparent decision, to continue to overspend in an old technology in nuclear, when all it has to do is just have a look at a South African export or South African exports and what they're doing in Silicon Valley with renewable energy, being the Reeve brothers and Elon Musk. This deal between Tesla and SolarCity, to get back to the pricing, Tesla is 93.5% of the deal. So SolarCity is a very, very small part of it. But Elon is of the view that by merging the companies together, it'll give solar a good boost to go more into its area. It now is going to start manufacturing. Why, he says, should SolarCity be manufacturing its own storage facilities, in other words, batteries, when Tesla's doing the same thing, etc., etc. So there's lots of good reasons why that is going to be 1 equals, well, probably in this case only 2.5, because SolarCity is very small compared with Tesla, but still it is an excellent opportunity, given that the market is a little confused. Mr. Market's a bit confused and grumpy and not too happy about the way that the deal is being structured. I think the deal has been structured perfectly. I don't believe that, given that they grew up together, Elon Musk is going to screw over the SolarCity, his cousins who run that business. And I think it just gives us an opportunity now, at last, to back the South Africa's greatest entrepreneurial export. So I hope that I've made the case there. It is, however, still fairly risky, and that's why we are only putting, of the cash that we have at the moment, we're putting 2/3 into Facebook and 1/3 into Tesla. But Tesla is a great addition to the portfolio, could be another Amazon for us.
Look, an interesting question from Jenny. She wants to know if the portfolio will stand up to Donald Trump becoming US president. I'm looking at investing in the Vanguard S&P, see if it's a good idea. I'd like to drip feed money into it over 3 or 4 months, and wondering if she should go now or wait until next year with the election coming up in November.
It's a good question, and that's something, when we look at timing, it always comes back to bite us. If you have a look at Tesla, timing in this respect, or waiting for it, actually worked in our favor. When I go back a little more to Facebook, unfortunately, trying to wait and trying to time the Facebook entry point has been a mistake. So better to do it the way we do it. Don't worry about the big story. And Warren Buffett says that as well. He says you can't tell what's going to happen in the big picture. He's worried that if you ask him what concerns him most, he's worried that there will be a nuclear explosion in a US city, for instance. He's concerned about that. That's what keeps him awake at night. Elon Musk is similarly concerned that some crazy guy is going to blow up the world. That's why his whole intention is to try and get mankind colonizing Mars, so that at least mankind as a species will exist into the future. And that really is. That's the reason, the big motivation that he's got for his whole business, the whole SpaceX business, and the whole advance into space is based on that premise, that maybe some crazy guy is going to blow up the world because we now have the reason to do it. But if you start worrying about those kind of things, you wouldn't sleep at night. So to worry about a Donald Trump coming in as president, which Clearly doesn't look like the case, but this has been, in the last 2 years, we've seen so many upsets, you can't bet against it, and certainly don't have any bets in that presidential election. But if you buy shares over a 3-month period, you will, at this point anyway, be able to offset both the Rand and the Trump effect, if you like. I think one of the mistakes we made, a mistake we did make ahead of Brexit, was assuming that Brexit was going to be, that the Remain camp was going to win, because everybody said so. The betting suggested 27 times the odds for a Brexit Remain victory as against a Brexit leave. So everything was in that way, and we didn't follow our strategy of buying over 3 months with Barclays. Had we done that, we'd now be showing a fantastic profit on Barclays. We bought all the shares in April instead of perhaps buying it in April, May, and then June after Brexit. And as long as you stagger your purchases, you take out the timing effect as much as you can, and you also, in that way, offset the risk of buying at the wrong time. So that would be your idea of dripping in. Absolutely fine. What would Donald Trump do to the stock market? He would certainly have, he'd scare Mr. Market, but Mr. Market, of course, is not what you're buying into. Mr. Market, when he's scared, that is an opportunity for long-term investors. When Mr. Market is over the top enthusiastic, that is the time that long-term investors need to be concerned. So we actually like it when Mr. Market gets overly depressed, because that brings more value to the table for long-term investors. And if Trump were to win, and if shares were to take a horrible knock, what we might do then is look at the portfolio and see where the greatest rebounds are possible. But when you look at this portfolio, it's very, very unlikely that any investor who owns Amazon, Facebook, Alphabet, Apple is going to give up their investment just because a fellow like Trump, and with some pretty good disturbing economic ideas, would take over. Remember as well that although the President of the United States is a very powerful person, he also has a Congress that he has to get his ideas through. He can veto them, but they can veto him as well. So we might just have 4 years of stalemate if the worst got to the worst. But the U.S. economy has got the right structure, it's got the right constitution, it still encourages human endeavor, it is a bet on human ingenuity, and one man becoming president isn't going to change that. I certainly would not let that worry me on my investment decisions. So we're happy with Tesla, we're happy with Facebook. Goodbye Novo Nordisk. The performance of this stock, as you can see, we didn't know, and I guess neither did any other investor know what was in store for this company. In theory, and this is why we bought into Novo Nordisk, and this shows you the share price from the time that we invested. It has around about a third of the world's insulin market. Fantastic business that it is, because once you have an insulin analyzed for you by your doctor, you are unlikely to switch the product to someone else. So there's a huge amount of stickiness. But one of the things that we didn't really take into account, and I think investors generally were caught out on this one, was that the future opportunity for Novo Nordisk was always going to be in the United States. And the United States is moving very aggressively towards trying to address its healthcare costs. We know Obamacare has been an unmitigated disaster, but there is lots of other things that are happening in the US at the moment where healthcare costs are coming under increasing scrutiny, and the pharma companies, on the one hand, are being taken on by the regulators and others, and on the other hand, there are lots of new developments, lots of new investments. Big data makes research much easier. In the old days, if you wanted to research a cancer drug, for instance, you pretty much had to be very, very well resourced, and that's why you needed long periods of exclusivity if you were to invent a drug like that. You'd have these banks of researchers who'd be looking into it. Today, data, or the ability to crunch big data, takes the human factor out of that and gives many, many people access to this market. We've also seen people coming at it, or companies coming at it in a different way. Alphabet, Google, or Google's parent company, for instance, has got one of its target areas is in the healthcare sector, where it's putting a lot of attention now to those of you who might have seen many years ago, there was a movie called I think it was called The Impossible Voyage or The Impossible Adventure. It was about these little guys who were shrunk and then put into someone's body to go and attack a malignancy there so the person could live. It's that kind of thing, which is now, then it was science fiction, it's becoming science fact. So all of these things are changing the medical industry quite dramatically. And as far as Novo Nordisk is concerned, it went into the United States with one intention from a pricing perspective. Its prices have now been really, really squeezed, and to the degree that it then started exposing some of the problems within this Danish company. The chief executive was fired. They're now going to be retrenching thousands of people. And it's almost like the facade that was there for many years of Novo Nordisk, of great solidity, has now been stripped away. Also, the transparency levels for companies that operate in Europe are much lower. They're under far less scrutiny than those in the United States. And as we know, the more scrutiny you're under, the better you tend to perform. Now that all of these chickens are coming home to roost, Novo is having some pretty unpleasant surprises, and we think that generally speaking, it's time to depart. As you can see, those of you who follow technical analysis, it's well below the moving average, and the moving average continues to go lower, and that's on very high volumes in these shares. So it's many of the long-term holders are, like us, deciding to take their punishment and to move on. And we've decided that Tesla and Facebook are much better investment opportunities than Novo Nordisk. Indeed, my hero, Warren Buffett, it's nothing personal, Warren, but we also are of the opinion that Berkshire Hathaway is more of a bet on old-style America, whereas the fourth industrial revolution is going to be giving disproportionate gains to new companies, exponential companies, and hence we have sold half of our shareholding in Berkshire Hathaway and invested, and will be investing that into both Facebook and Tesla. If you have a look at from a technical perspective, again, the share price has done very little in the last year. It has also been trading below its moving average for a while now. Berkshire is such a big company. There's not really much that you can think that's going to move the dial aggressively on this one. Also, a bit of a concern here, its biggest single investment is in Wells Fargo. Wells Fargo has, well, ejected its chief executive. This after the scandal where 2 million accounts were opened on behalf of people who didn't even know that those accounts were open for them. Reason was that within Wells Fargo, the incentive program was encouraging staffers to open a minimum number of accounts to get their bonuses. Now, 5,300 staff of Wells Fargo have been fired as a result of this, and the CEO has taken early retirement after appearing before Congress and getting a real roasting there. But the issue that concerns me is that if Wells Fargo, which has been a very good performing bank for some years, if this is part of the DNA, that it's got people who work there who are prepared to cheat to go to meet their targets, and it has a managerial culture that incentivizes people to cheat to do so, then the problems might run a bit deeper. Buffett himself says that there's never just one cockroach in the kitchen, And in this case, Wells Fargo worries me. That might weigh heavily on the Berkshire Hathaway share price for a while. So it makes sense to us. We had a very large position in this company to lighten that so that we can put it into more interesting exponential businesses. I hope that explains it to you. Stuart, anything on your side?
Yes, Alec, a few questions. Dion wants to know, just on Facebook, where do you see future revenues come from?
Well, Facebook has got everything going for it. It's moving into the, if you like, into the Google space. How Google makes its money, and not a lot of people kind of understand that, is it gets publishers like us at Biznews to carry advertising, and it takes a chunk of the, and a big chunk of the money that advertising revenue generates. So if you want to advertise on the internet, your first port of call is to take is to go through Google AdSense or Google AdWords. You'll buy certain words. You'll pay a certain amount for your advertising. It'll appear on many websites, and Google will take a share of that as its cost now, or as its fee. The website owner, like ourselves, would also get a share of it. But what's happening is that Google's pricing is continuously falling because there is an infinite number of people who can create pages, or there's an infinite number of pages on the internet. So as you get more pages, you get more supply, and people will get a better deal for their advertising. What Facebook is doing now is it's moving into that in quite an aggressive way with Facebook Instant, with publishers. So publishers like ourselves, we would now publish some of our stories on Facebook, within the Facebook environment, and share in the advertising that gets generated from it. That's a whole new area and a whole new competition for Google, but on the other hand, a much bigger competition for outside of that, for old media, for the newspapers and television, and to a lesser extent radio. So that's the first area. The other area that cannot be underestimated is that Facebook has got hundreds of millions, literally, of people about whom it knows so much, and to whom it can now offer new services. And the obvious service is in financial services. So if you can imagine a world time where we would probably have Facebook, here in the UK, when you go to buy something under £30 in a Starbucks or one of the other fast food outlets, coffee or a small restaurant, you simply hover your credit card on top of the payment machine. Indeed, when you go on the underground now, you can use your credit card again, just instead of an Oyster card, which some of you might know the way that works, the underground works. That is one step towards a completely electronic society. And the biggest loser in that area has to be the banks, because the payment systems are very expensive and have been built on the basis of having to keep capital requirements, etc. The big disruptors in that area are people like Apple, who've now got something called Apple Pay, and Facebook, which hasn't even moved into the area yet. You've seen M-Pesa in Kenya, and similar type of payment vehicles which you can use on your cell phone. That's an area where Facebook is now moving aggressively, and the potential from that field is, it's so big that it's hard to get your head around it. Exponential growth is in prospect for Facebook for a long, long time. I think that's, I hope that answers that question, Stu.
Thanks, Alec. There's another one from Matt. He says, you mentioned the business portfolio is aimed at helping South Africans diversify against the rand. If I were to emigrate, would this portfolio still work for me wherever I go?
Yes, it's there's when we get into the immigration question, there becomes many other issues that are relevant here. But what we're saying is this is a portfolio for South Africans who want to be less exposed to the eccentricities of the economic decisions or economic policy decisions that are being taken by the ANC government. I mean, if you want to boil it down to the basics, that's what it's about. South Africa is about 0.5% of global GDP. So if you can imagine, it makes it 1/27th the size of California, just to put it into context. It's a small country, and it is like a cork in the ocean. And although there's some good businesses in South Africa, and Discovery, which I mentioned earlier, is an obvious example of this, you really don't want to only invest in 0.5% when you've got the whole world to look at. What this portfolio does, is it gives you immediately that opportunity. If you were to emigrate, you could either keep the portfolio going in South Africa through WebTrader, or you could sell it and buy the shares somewhere else. But the ability to, well, you could actually apply to export the shares through exchange control, through the Reserve Bank. And for most private citizens, there's very little exchange control that will block you. You just have to go through the processes. You just actually have to make the applications through the Reserve Bank. So no impact whatsoever if you were to emigrate. This is your asset. You would apply for the externalization of your asset in a way that you would with any other asset. And incidentally, Standard Bank have got significant operations in the UK still. In fact, they've got a very, I think the Isle of Man, the biggest building in the Isle of Man, is owned by Standard Bank. So the company has got, although it's sold out, it's quite a lot of its businesses, its trading businesses, etc., to the Chinese partner. Standard Bank still has got a lot of retail operations here. So if you have the portfolio, I'm sure they'll be able to find a way or help you to externalize that if you were to emigrate. But that's not the purpose of this. The purpose of this portfolio is for South Africans who are staying in South Africa not to be exposed to a deterioration in the economy of the country.
Thanks, Alec. There's just a quick one from Dirk. He says he sold his Novo Nordisk, and he wants to know between Amazon, Facebook, and Tesla, which one should he invest in? He doesn't own any of the stocks at the moment. I think he can only invest in one.
I'd split them. I'd just split it 3 ways. Keep it simple. It depends how much money you've got. If you've got, as long as you've got enough money that isn't going to make it onerous because of the dealing costs. In other words, if you've only got like $500, then you might, my breakdown would be number 1 Amazon, number 2 Facebook, number 3 Tesla. That would be my choice. If you only had $500, I would go with Amazon. But if you have got enough that will enable the size of the deal to be of such a size that you aren't paying huge commissions proportionately, then keep it simple. Maybe the way I've gone is for 2/3 Facebook, 1/3 Tesla. Maybe in this case you could go 50% Amazon. Just follow our portfolio really. 50% Amazon, 30% or 35% Facebook, and 15% Tesla. That would be the way I would my breakdown of those 3 would be. And if you can, please try and buy it over in 3 different periods.
Thanks, Alec. I see time's flying, but there's a question here from Yaku. He wants to know, if you'd had to start the similar portfolio today from scratch, would it be any different, or would anything be different?
I'm very happy, Yaku, with the way it's structured today, as where we are right now. Clearly, I'd have been a little more cautious about Barclays, but Barclays in Rand terms is offering great value. Remember, Barclays, the purchase there was on the basis that they would be selling ABSA in South Africa, or Barclays Africa, and that they're going through a turnaround as well, and they've got a really good franchise, high street franchise in the UK. It's just cheap. Barclays was a very, very cheap option, and it is one of those companies that, with the new management attention, I'm confident is going to perform in the long term. Outside of that, I'm quite happy. I'm actually very happy with the structure of the portfolio as it is. You said time's flying, so let's just fly through the rest of the slides if we could. There's the Vanguard S&P 500. That's the index for the US market. As you can see in the last year, very little. It's up about 5%. Technical analysts would be a little concerned that it's below the moving average, but this is a 1/5 of our portfolio, very defensive positioning. Alphabet, by the way, those are the founders of Alphabet, Sergey Brin and Larry Page, still pretty young, two of the richest people in the world, and they've done it on this shared value concept, which is, so they've made us better off, so why shouldn't they be better off as well? It's had a big jump in the last couple of days. As you can see, it's now comfortably over $800. It only came in the last few days. Alphabet reports its financials on Thursday. Those of you who like to follow these things, analysts are expecting $8.63 in earnings. If it's any more than that, you can see a bit more. You'll probably see yet another spike. If it's any less than that, the share price will probably come back. But to Thursday after the U.S. market closes is when Alphabet will be releasing its results. Amazon, there's Jeff Bezos, the genius that he is, and it's been a bad decision not to buy Amazon any time since March 2016. It really has been a wonderful performer. And it's funny, this one, when we bought it into the portfolio first in December 2014, it took a few months to find its feet. And in fact, at some point in time, it looked like we were going to have an underperformer here. But the business model is unbelievable, and I would suggest that you follow very closely the reports. We'll have stuff on Biznews tomorrow. Tomorrow morning when you wake up, the Amazon is reporting this evening. If it comes out with revenues anything more than 30 billion, you can expect the share price to take another very sharp improvement. I'm going to be watching for the Amazon Prime. I'm a member of this. It's a fantastic service. You get lots of free music, free videos, you get free delivery to your homes. That has gone, I think you pay 89 pounds a year for that privilege. The membership of Amazon Prime has gone from 44 million 2 quarters ago to 54 million at the end of March to 63 million at the end of June. Now imagine 63 million people are paying you, call it $100 a year, and that's just coming in through a subscription model. If that goes any higher in the quarterly results, it'll be an even bigger bull point for Amazon. Apple has done much better in the last little while. As mentioned, it was just over $90. In fact, it touched $90 in earlier this year. If you'd bought in May, you'd have been a very happy investor. Unfortunately, we bought a little bit early, but it has bounced off a couple of times off the long-term moving average, and it's now moving in the right direction. The results coming out today after the market closes, we watch there for anything above $1.66 in earnings per share. That will give it another kicker. One of the big bull points and one of the reasons why Apple has been moving well in the last few weeks has been the problems that its big rival Samsung has had. Samsung 7 experiencing spontaneous combustion, etc. IBM, well, not a whole lot more to report on this one until the quarterly results come out. It is a long-term bet for us. It is a company that has had huge investments in the past, in the old economy, and moving those into the new economy. This takes time, but it is doing the right thing. The strategy is right, and certainly it is starting to, for long-term investors, it's starting to make even more appeal. This is one that Warren Buffett keeps buying into, and we would be very, very comfortable to be holding onto these stocks. Barclays, that's the UK investment. As you can see, it's got a long way to go to get back to where it was even a year ago at 250p, but it's moving in the right direction after that terrible knock post-Brexit, and we do think that given the opportunities that the company has with its turnaround, that Barclays is worth holding on to. As far as the pound is concerned, well, that's been depreciating even against the South African rand, so that's taken quite a bit of shine off the Barclays share price. But on the other hand, it does appear as though once the Brexit story is settled in the next 2 years, the pound will at that point start recovering. There's lots of uncertainty on the pound in that period. So in that time, rather take the pound out of the equation and just look at buying the stock. And there it is, just closing off the portfolio for you. As you can see, the annualized return now is at 29%. That's in the 22 months, 54% overall. That's in South African Rand terms. And the Rand itself has been a big contributor to that, with its depreciation from 11 Rand 27 to the US dollar to 13 Rand 79 as at today. Stuart, that's pretty much bringing us to the end of the portfolio wrap-up for today. Anything more that we need to conclude with?
That's all good this side. I like nothing else. So thanks very much.
Well, it's been my pleasure once again, and we got some new stocks to analyze and new stocks to look at. The idea of this portfolio, please, is it's a long-term investment. The average period of holding is forever. I'm very happy with the portfolio the way it's currently structured, and if you have not come to the party yet, if you haven't invested in these stocks yet and are thinking maybe now is the right time to do it, my strong advice would be to stagger it in over 3 months. So if you have, say, $100,000 that you would like to put into this portfolio, that would be, I guess, around, well, $100,000 is more than R1 million. Let's just say you have R1 million to use that easier. Then the R1 million, you don't have to ask for exchange control approval at the moment. You literally can give that to Standard Bank today, and they will be able to convert that into dollars for you. You wouldn't want to do that, though. You'd want to shift it across 1/3, so 33,000 Rand today, and then allocating 330,000 Rand today, allocating that according to the holdings, again in 1/3 at a time. So you take your 330,000 Rand, put it into the holdings as we have them here. You can do that all yourself, pretty easy. And then in a month's time, you take your next 330,000, and in the final month's time, you take your final 330,000. So just stagger it over 3 months. That will take away much of the risk in currency and getting the currency wrong on the day that you're buying in, and also much of the risk in the actual share price itself. I hope that that helps you to grow your wealth, and look forward to being back with you next month. Stuart, ready for you to start?